What's up, YouTube? It's Joe Ketchpalia sitting on the couch making some money investing in fractional real estate online as usual. Well, not exactly as usual today. I'm going to be talking about something quite a bit different. This is kind of some nerd stuff. I haven't done this in a little while. I was doing it quite a bit more early last year, where I would just talk about real estate investing concepts or ideas, or like how it can relate to fractional real estate. So there was a discussion in the Discord the other day. There's a disagreement about the correct amount of leverage and whether we should be using leverage at all. And for fractional real estate, for traditionally trained real estate investors, like classical finance people, we all have just been taught, leverage is one of the main reasons that we should be investing in real estate. Like there's very favorable borrowing rates compared to almost any other type of investment. There's also, you can get higher leverage than you can on most other investments because lenders have typically, a couple of reasons. Lenders have typically looked at the asset as being a safer asset, but also here in the U.S., the government is really involved in a way that basically subsidizes our mortgage rates by protecting lenders with our conventional lending products. And so, in general, real estate investors are taught to use leverage, and especially the way our tax system works, where we can depreciate the whole asset, even though we actually only, and this is getting too far afield, but in general, I think, and when I came out of school, I have a master's in land economics and real estate, and when I came out of that program, I very much believed in levering deals basically as high as a lender would allow me to, right? Like I wanted to have a debt coverage ratio, or a debt service coverage ratio. I understood that there was some need to be able to pay for that debt with the income from the asset. But beyond that, didn't really think a lot about the risk of ruin, right? The ability to weather future storms to the point where I'd actually be able to realize a return. And one of the reasons for that is we're very much trained to look at expected value in investing in classical finance, and this works really good in certain areas of life, but it doesn't necessarily translate well into investing or because of what's called an ergodicity error. And so this is, like I said, this is going to be one of my nerdier videos, so feel free to stop watching if you just want specific due diligence on specific properties or platforms. I think this info, if you really think about it and internalize it, might help you decide, do I want to lever my investments? Both in one of the things that's interesting about the fractional real estate space is now we have some options, right? Some of the platforms buy properties with no debt whatsoever. Some of the platforms buy them with traditional debt, like Mogul uses relatively traditional debt, although they're using interest-only loans. But beyond that, it's pretty normal, even especially in the commercial real estate space, to use interest-only loans anyway. So I would say it's the most traditional real estate investment like setup is their platform. But then you have also, at least starting to bubble up on Lofty, they've been talking about having a lending product to lend against your tokens, right? Which is a second level of leverage. They haven't rolled that out yet, but they've been promising it for quite a while. But just recently, the Universal Lending DAO is now going to start lending. We just had a vote. We're going to start lending against tokens to individual borrowers. How that's going to work is yet to be seen. We haven't actually done one yet, but we're in that process. And so there's so now we have multiple ways that we can lever our portfolios, right? In options across the board, right? We can do anything from purchasing on some of the platforms that only own properties all cash to buying a levered product on Lofty and then levering your tokens. And my guess is we will start to see that type of lending on some of the other platforms as well, especially the ones that so some of the ones that have that aren't using mortgages at the property level are already talking about, at least, maybe not publicly, but some of them are already talking about a margin type product on their securities if they're ones that are actually creating securities. In thinking about, okay, should we use leverage? If we use expected value type calculations, the answer is almost always yes, right? And it's more is better as far as when you look at your long-term expected returns. As long as it's accretive debt, right? As long as you're basically that your cap rate is higher than your interest rate, or higher than your mortgage constant if you're not using IO. Somewhere in between that, maybe, because some people think it depends on how you look at paying down the principal balance. So it could be accretive from a profit standpoint, but not from a cash flow standpoint. But that's I think I'm getting a little bit too much into the weeds. I want to just talk about this idea of why I think there's this big mistake being made. I'm sure I'm going to butcher this. I'm not a mathematician or I guess, people with less economics education than me claim to be economists sometimes online. So, I wouldn't mind thinking about myself like that, but I'm really not. But so I'm going to describe this in the, in the 8-year-old version of understanding that I have of it. So, and I'm on this is just a Medium article, a little, a big little idea on ergodicity, ruin, and rationality. This would be something great to read if you want to get some more info on this. But I'm actually just showing you this because they have some good charts. So the idea of so we're going to have two different ways of looking at groups of data. So this line across here is if this line was one individual real estate investor, and this is their returns over time. And then this is a second individual real estate investor and their returns, a third, their returns, a fourth, their returns, a fifth, and their returns, right? And so this is a time sequence of returns. And so you could take this little group here, right? Just a slice in time, but you're taking, you're looking at all the investors at a certain slice. Or you could look at one investor over the whole time period. And so a system, is considered to be ergodic. And this is, just defining the term because I'm going to be using it a little bit. If, so this, when you're taking the slice, one slice of each investor over in one period of time, they call this the ensemble, ensemble group. And then they call this the time, I think time average group, right? And so a system is ergodic if when you look at the ensemble numbers, they're equal to the time value numbers, right? And so this is actually, that seems crazy to think about, why would that be the case? But this, there are systems out there that are actually ergodic. Investing I don't believe is, but because so much of our, our economics, we're basically, so many of our principles are sort of built around this idea that we can just take, what are these averages? What are average returns? And now we're going to apply these to individuals. And so you can see how that could be a mistake, right? And so one of my favorite articles about ergodicity, and it's, if you don't read this, ergodicityeconomics.com, there's some great YouTube channels about this, but they have this, basically this thought experiment where they're flipping a coin. If it comes up heads, you get, your wealth increases by 50%. If it comes up tails, your wealth decreases by 40%. And so your expected value there would be positive, right? Because like, let's say I start with $100. If I win the coin toss, I make $50. If I lose the coin toss, I only lose $40. If you gave me those odds to gamble, I would want to just keep making that bet, a million times over, right? Because your expected value is, is positive. I mean, you can see that. But they didn't say, but what it isn't being taken into account is if I flip the coin and lose, now I have $60. And so the next time I win, I'm not winning $50 anymore. Now I'm getting $30, right? So I went down to 60. So now if I win, I'm only getting up to 90, right? And so you can see how even though if you took a whole group of investors or a whole group of players, they all started with $100, and you had them all flip those coins, because half are going to win 50 and the other half are going to lose 40, the expected value is positive, right? But because as you lose, the next time you win, it doesn't make up for the full loss. Over time, an individual that continues making that bet for their whole net worth, right, the whole whatever they have left in money, that time their actual income is going to decay. And so that's what you can simulate this over a bunch of rounds. And so this red line shows, okay, this is the expected value of the total coin tosses is really high, but the actual, looking at the time decay of the individuals, it basically, they're losing much faster. And so if you did this, if you started with a sufficiently large group, the reason that it's so high is you'd have the one very lucky coin flipper that just kept winning, and they would have an unbelievable amount of wealth, where virtually everybody that you took samples of would have lost money in the long run doing this. The first time I ever came across this idea, it really blew my mind. You can see this idea of ergodicity mistakes, I guess, where these, I've always just thought of, being just a classically trained finance guy, that if you have a positive expected value, that it's got to be a good investment. It wasn't until I got into reading the Taleb stuff, and then also, I can't even believe I can't think of his name right now, but the guy whose book I kept talking to you about, The Most Important Thing, last year, is where I really started to realize, oh no, it's not the whole story. And that's where I was first introduced to this thought process. I think was from one of Taleb's earlier books. That's Nassim Nicholas Taleb. I don't know, if you haven't read all of his stuff, you should read all of it, and it'll change change the way you look at a lot of the investing. And but so what does this have to do with? And so this is I think to me, this is not really intuitive, even when I explain that math. But so there's another way that you can look at it, where it's basically path dependence or time dependence. And so a separate thought experiment, and I'm gonna loop back to how this equates to real estate after I do this example. So you have an urn that has one red ball and one green ball, and whatever one you reach in, you don't look, you pull one out at random, and if it's a red one, then you add a red one to the thing. So then you're going to have one red one, then you're going to have two red ones and a green one. And then each time you reach in and pull it out, you're going to do the same thing. And so if you have a bunch of people doing this, on average, each is going to start with the different color ball. I'm actually using a couple different papers, because this one I liked. They were using white and blue in this one, but it gives you a better visual. Okay, if the first one you pull out is white, then you have two whites and a blue, and so you're twice as often you're going to pull out another white, and then you're going to so over time you'll tend to have far more whites and less blues, in your earn if the first one you pulled out was a white. But if you had 100 people or 1,000 people or a bunch of people doing this, and you looked at all the balls at the end of the day, the average should be around 50-50, right? White and blue. But depending on which one you pulled first is going to affect your future much more strongly. Now, you could have a situation where you just randomly, end up in this middle ground, but over time, you'll tend to drift one way or the other because your earlier result has an impact on your future, chances of pulling that certain one color or the other. So I don't know. This one, I think, intuitively to me is a lot easier to wrap my head around, like why the average of the whole group would be 50-50, while any individual would be skewed really far one way or the other. But anyway, so okay, why does this matter, and how does this get back to real estate? Well, the thing is, when we're doing so basically understanding that makes you realize, and especially this, the sequence of investments and this first, the coin toss, where if you have a situation where your losses can hurt you more than your gains can help you, which is, I think, very much the case in real estate, especially if you're highly levered, then there's a huge risk of ruin, right? And this has been what I've noticed overall in real estate. So, if you think about, like, over time, my view really became the only thing you have to do is survive in real estate. If you're in the industry long enough, you're going to become wealthy, right? Like, it's as long as you can keep making those investments, you don't lose your properties. Time is really doing the rest, but the ability to actually survive the downturns is something that not ever. I mean, like, when 2008, that time period wiped out tons of people. I was a really new investor. I bought my first investment property in 2005. I didn't have a ton of units going into 2008, but I knew a lot of people that were further along than me, and tons of them got wiped out and never bought another real estate deal again. Now, some of them, there's a couple of reasons that this is, like, exacerbated in real estate, and part of it is, your ability to buy deals, to a certain extent, depends on your credit and having not filed for bankruptcy. And these are two different things. A lot of times people think it's the same, right? But on almost any mortgage application, even if it's one that's not looking at your credit at all, they still ask you, okay, have you ever filed for a bankruptcy? And answering yes in a lot of cases is going to rule you out or make it just much more difficult to get that mortgage. And so there's a lot of people that, got crushed during that 2008 timeframe and just couldn't qualify for mortgages to start investing again, even once they got back on their feet. And so that's something that doesn't really fit into the data very well, right? But it is, if you're, if you start your career, or, if you experience losses early, like anybody who started, and I think I was pretty lucky. Also worked very hard, but was pretty lucky not to get wiped out going through the 2008 timeframe. I mean, I worked in commercial real estate and changed jobs more than 9 times in a short period of time to be able to keep things going. And I never had anything foreclosed on, but I did come close with one property. I liquidated some stuff, so it was a tough time, and it was a time that, somebody who experienced that either, with a little bit less time to be prepared for it than I did. Because, like I said, I mean, my very first property that I bought in 2005, I actually was able to sell it in 2009 for a profit, and I used some of that to keep some other stuff going. If you bought your very first property in, say, 2007, you might have just had no chance, right? And so depending on what, if you lost your job as well and all that sort of thing. And so the timing really impacted, the timing of when you got started really impacted your investments. And that's just not something that when we look at so, okay, looping back to really how we're looking at real estate deals, right? When we're making projections, you see, like, we're often like, okay, we're looking at average rents, we're looking at average, average appreciation rates, and a lot of that stuff is impacted by this same type of error, right? Like, so for example, there's no reason to believe that the rental rate in your particular property over your hold period is going to fluctuate at the same rate, going to increase, or however, whatever you're predicting, at the same rate that the whole market rental rate has moved over the, the period of time, whatever data that we're using, right, to make that projection. And this is one of the reasons why, they always give you the disclaimers when we're projecting things into the future and whatnot. Okay, so we know this error exists. We know it affects us. So how do we, and actually I just asked, just put this into the little AI mode here. And it talks about, using this average fallacy, right? Like, we see that a lot. But another thing that they talk a lot about, that becomes a problem, is over leveraging. And like I said, in the model of expected value, there's virtually no good way to explain why over leveraging is really a problem, right? Because you're not seeing, as long as your average deal is making money, you don't see how it just ends the progression of the individual investor, right? Like, if on average your deals are making money, it doesn't matter if your first deal failed and then you can't continue, or you don't have the money to invest in the next one. The other thing too, I don't think I mentioned this at all, right, is we always, like, when we calculate IRRs, we're always looking at a constant reinvestment rate. And that's something that, especially in traditional real estate investing, you can't do, right? Like, you can't just, okay, I got $7 left over after I paid all my bills this month, and from my rent collection, let me reinvest that in the next property. It's actually a good argument for investing in fractional real estate, right? Because we can continuously reinvest even small sums of money in a lot of these platforms. Now, one of the things that we're not doing, though, is our rate is, as that's being reinvested, we may not have access to the same types of deals that we were assuming up front. And so, we can run into that timing issue again, where we're reinvesting at times where, so for example, all the deals I bought a year ago on Mogul look much better than the deals that they're putting out right now. If you're starting today buying on there, you certainly can't just look at the average of the deals that they have, held for over a year, because I wouldn't expect those same returns, because they're not finding those same deals today. And so, there's that's an issue. And then, the ignoring transaction costs, I think that's an issue, but it's not necessarily, I don't know. I mean, it was kind of interesting to me that this got put into this same thing, because there's no reason that you have to ignore transaction costs when you're doing that math. So I don't know. Maybe this is just something I'm ignorant of. I thought it was an interesting one, though. But so I loved it. It gave the three ways to mitigate these ergodicity errors, and they're all ones that I'm a huge fan of. And I just want to talk a little bit about, what I think, how they impact us, what I think we should do, but also, like, so the very first one that they said, okay, diversification, and I think, like, this is something that. I'm diversifying across different platforms, right? I'm diversifying across different asset types, different business models. I've got pad splits, short-term rentals, long-term rentals, several different states. this is one of the things that's just amazing about fractional real estate that you don't get with traditional real estate is the ability to do that, right? I mean, I don't have a ton of money invested in fractional real estate. I think altogether I still have less than $100,000 across all the platforms, which is the amount that I had initially set aside for experimenting and, or plan to use. And so I could, over time, I'll end up putting a decent amount more, and we'll be able to just have unbelievable diversification relative to if you took just took $100,000 today and you wanted to buy properties here in San Antonio, you might be able to get 3 single-family homes using that $30,000 down pay. Each putting about $30,000 down on each one. Or if you were going to do like owner-occupied, like house hacks, you might get away with even less. But yeah, I mean, if with that much money, I mean, you might even need a little bit more than that, 15, 20%. I don't know. Because we have some homes that are like 140, 130. So you might only be able to buy 2, right? I mean, so your diversification, and I know in some markets you might be able to buy 3 or 4. But there's no market that I know of that you could go out and just buy a bunch of homes and get, and if there is, then you're just not even diversified across markets, right? And also from a work perspective and a building a team perspective, all of those things, I think, is something that you benefit from fractional real estate. It's one of the reasons that, I think, I mean, I don't want to say you're using it wrong, but I think a lot of people are kind of just not taking full advantage of fractional real estate, right? If you're only on one platform, I think you're taking an inordinate amount of platform risk, and so you're not getting that sort of diversification there. But also, there's people that are putting very large chunks of capital into a very few properties. And they're doing the same thing, right? Like it is, yes, you're getting more diversification than you would by just going out and buying whole properties. But it is, I think that there's not, it's tough, right? Because you have to do the due diligence. And then like on platforms like Lofty, which is where I see this the most, it does take a lot of work to keep up with your properties. And so there's a trade-off there for time, right? Like I don't want to have, and I've talked about this a lot, like I don't want to just have a couple $100 in a property because it's not a good return on my time. But at the same time, I don't want to be putting huge sums of, tons of capital into any one property because it's like one of the main benefits I'm getting. I see diversification as being one of the biggest benefits that you get from fractional real estate. The liquidity reserves, I think that's, which is the next thing that they talk about, how to mitigate it. This is what, this has been hugely contentious on Lofty, right? Like there's constant arguments about how much of a reserve we should have, and I had thought from day one that we just did not have anywhere near the level of reserves that we should have had in a lot of the properties, and we weren't like allocating any portion of our NOI to reserves in most properties, and so most of them couldn't even handle a tenant turnover, let alone if there was like a real downturn in a specific market, right? And so I think it's, and you can see actually some of the other platforms too. One of the things I always talk about Mogul is I love how large their returns are. Reserves are, right? Like I think that they are putting a much larger amount of capital to the side on most deals. And, to be perfectly frank, on some of the short-term rentals, I'm getting worried now that those reserves weren't actually big enough. That's yet to be seen, but it's not looking good for some of them. And, and so I think there's a real risk of some of those short-term rentals going under. We'll have to see. It's so far it's been a pretty short period of time that they've been running. And so, and I think Mogul is in the process of sort of figuring those out, but anyway, I really like that they've had larger reserves. I talked about how, on Lofty, it's been argument in lots of different DAOs. I'd like to see there become a certain standard where, across the board, we're just going to have a certain size reserve in the DAOs. I know that kind of goes against the idea of them being self-governing, but I think that Lofty could easily say, the only types of companies, in order to trade on our platform, you have to have a certain level of liquidity. You have to have reserves of XYZ, right? I think that that's possible for them to do without those becoming securities. I don't know that for sure, but that's my thought, right? Like, they could have certain rules of, okay, to stay listed on the platform, these are the criteria, and having significant reserves is one of them. But if you look at some of the other ones that are even securities, some of them are borrowing from the entity that issued them, right? Like, they don't even have, they already burned through whatever small reserves they raised, and I think that's sort of terrifying to me. And so, focus, the last thing that they says, to mitigate these errors is to focus on long-term survival, right? Prioritize not going broke over maximizing short-term gains. And I love that it spit this out, because this is exactly what I was talking about in the beginning, is that I've just always thought, if you survive long enough in the real estate industry, you will become wealthy, right? Like, it is, but surviving is the hard part, right? Because a lot of people do over leverage, right? They run into big downturns. They're not capable of handling it. And so when I'm looking at the deals that I'm buying, that's one of the reasons that I don't, that I have been pulling some money off of Lofty, is because I have my long-term outlook for that platform is not great. Even though I've been making great returns on there by buying discounted tokens, and then, pushing for real world sales or just trading on there, it's really hard to see, without them having some significant improvements, which they are working on. So, I think it's possible that they're going to turn things around. But at the moment, my long-term outlook for that particular platform isn't great, as well as, I don't feel great about Collab, as I haven't been putting money on there. BrickSave, I think they're moving in the right direction though on stuff. I think, it's going to, and that's why I really want BrickSave to put out their numbers as far as how they're paying for that dividend, right? That's been my main issue with them, is I want to understand what does their long-term survival look like? Is it possible, right? Or are those entities going to go broke? And without getting full details on those numbers, we just can't know. But so that's why, it's why the main thing I talk about on this channel is digging into the due diligence. What's gonna give us a problem? How are we gonna have issues? Much more so than I think this one's gonna, trying to pick ones that have the best returns. And if you go back to some of my ones about some of the videos I did about that book, The Most Important Thing, and some of the ideas in there, this was, a big key in that as well, right? I'm trying to rule out the ones that I think are going to be losers. I'm not necessarily just going to try to pick the few that I think are going to be the biggest winners, right? I'm trying to get really wide diversification. All I'm trying to do is really rule out ones I think will be losers, to a certain extent, to the extent possible, right? And so some of the platforms lend themselves to wider diversification than others. I think all the ones that are just pure securities are going to be the easiest ones to get real wide diversification, because I believe I think that the tax forms I get from those will be consolidated. I'll get one 1099 dividend or whatever I'm going to get, versus getting a separate K1 for every property, like what we're getting on Mogul. That's going to be cumbersome to buy. I don't think I'll ever have 1,000 properties with them, where I could imagine doing that on some of the platforms if I'm getting consolidated returns. But then on Lofty, I think you can't do it because it's too hard to keep up with all those properties and the voting and being educated and whatnot and having any serious amount of voting power. So anyway, I got off on a weird aside. I mean, this whole thing has been, just me sort of rambling about this general idea and why I think it leads to, that these are the things that we should focus on. And it's, even though I don't think I've probably never used the word ergodic or ergodicity errors or anything like that. It is sort of like underpins some of the thought process that I have in this space because of the writings of the people I mentioned earlier. And, unfortunately, it's not like, and I don't know, maybe it isn't, maybe, what do they call it? Ergodic economics, or what is it? Which one is it? Ergodicity economics is what maybe that's taught in some schools and finance classes now. I'm actually not sure how mainstream these ideas have become. If it's just like nerdy people like me that are coming across these or what, but I do think that it's good to have sort of the mathematical and theoretical understanding of why these things are important and why, like, more leverage is better is just not the right answer, right? It's not backed up by math when you're doing the right math, which is, my contention is that this is the right math, right? Like the ergodicity, by looking at the time series of investments versus the ensemble series or the ensemble set, and having, which leads us to the focus on long-term survival, the focus on liquidity and diversification, all of which, I just think that we have so much more opportunities in the fractional space than we do if you're out there, especially in the early years, right? Like if you're putting a lot of people, they're basically putting their whole net worth in their first investment property, versus you could take that same sum of money and buy pieces of 25 or 50 or even 100 different fractional deals, and well, you might give up some, you're definitely giving up some control. You might give up some upside, right? Like, I very rarely have deals that I find on here that are like the deals that I've done in real life. Like my actual returns on real life deals are way better. But, a big part of that is I'm getting compensated for the effort that I put into finding the deals, putting them together, operating, all those sorts of things. And so I think the more you are thinking about, avoiding that risk of ruin, the better, which is, what this thought process leads us to, the better fractional real estate looks compared to regular real estate investing, at least until you get to a certain scale where you could just go and buy a larger number of, real world properties. I think that's really everything I want to say about this. If you guys want to hear me talk about topics like this more often, I know I was doing it a lot last year, and just kind of got off track with it. Sometimes I just feel like it is just me, like, kind of rambling about some ideas that are, rolling around in my head. Honestly, I've actually been digging into ergodicity a lot lately, because I think I've mentioned on here a couple of times that my only real hobby or passion other than real estate is poker, and so a lot of this stuff comes into play in that game quite a bit. But there's so much overlap between being a good real estate investor and being a good poker player, especially depending on the format, right? But realizing that you're, I don't know. This is not a poker channel, so I'm not even going to get into all that. But anyway, if you are interested in more of these sort of like theory topics in real estate investing versus talking about specific platforms and specific properties and whatnot, let me know, because obviously I like to ramble about this stuff, but I just want this channel to be useful to people. And if you don't find this type of stuff as useful, obviously I just won't do it. Anyway, until next time, I'm just going to keep making mistakes so that you don't have to.